All right. Once again, you are welcome to the training session of the Rich Vision Academy and for Forex for beginners. But let me tell you the truth. The topic of today, what we are looking at today, it's not just for beginners, it's even for professional traders. Quite a number of professional traders don't even understand this aspect. The topic for today is money management and the psychology of trading. I tell you, many persons that have been into this market never understand this aspect, and that is why you hear people have blown their accounts, they have lost their money, and so on and so forth. So it will do you a lot of good if you can set aside everything that you're doing right now and pay attention to this part. It's better you master this part than mastering any other strategy as far as trading is concerned. Once again, is your friend and partner Olushola Popola, chartered accountant, investment advisor, and life coach. So, when we talk about money management, what do we mean by money management? How does money management play? You see, money is a tool, is a device, is an instrument. We call it an instrument that you use to purchase things of value. So for you to buy into a product or service, you will require money. And a management of money is so crucial that I remember there was one time a very rich man in Nigeria, West Africa, the MKO Abiola. The guy, according to what it was said, the guy was so rich that at a point in time, he had to send his son, his first son, to go and read money management. Because you need, any fool, it's always said that any fool can make money, but it's only the wise that can keep money. And because of this, many persons who have made money, but they lack money management skills, they come into the trading atmosphere. This is one reason why people tell you, oh, trading is risky, because they come into it and they lose all their money. I was having a meeting somewhere and I was sharing with somebody, and the first thing he told me, he said, Forex is a very, very risky that you can lose all your money. And I told him, on the contrary, you can't lose your money in Forex. In fact, one of the safe business that you can do, one of the most secured business that you can do is Forex. And I'm going to prove it to you. I'm going to, at the end of, I understand this is about my 8th year of trading. So I understand when I say is one of the safest now kind of business that you can do, is this business where I can control what I can lose. So fine, people will tell you something. Oh, you have the risks of losing all your money. Yes, it's like the normal theory. But when you go with that mentality into trading, then you are going to lose. If you are not trained, then why do you expect to keep your money? So let's talk about money management. Money management is essentially determining your risks and profit before placing a trade. Without a sense of money management, many traders hold on to losing positions far too long, but take profit and winning positions prematurely. The result is a seemingly paradoxical scenario that in reality is all too common. Now, let me give you the idea here. You see, when you are trading, you see the market goes, you took a position to buy, and the market, seemingly goes against you. The drawdown goes to 1%, 2%, 3% of your account, 4% of your account. You will still be holding that market. You will still be holding it and say, I believe God. It is going to turn. It is going, there's one strategy that we always say in the market. We call it the prayer and hope strategy. The prayer and hope strategy is one very important strategy that a lot of traders employ, especially when they are in a wrong position. Instead of you cutting off that loss, you say it's going to change. It's going to change 1%, 2%, 3% negative. And before you know it, you are in about a drawdown of almost 20%. And you're still holding on that trade. Before you know it, the account is blown up. Now, let that same person, the trade goes into positive. Will that person allow the trade to go into first into good profit. He's waiting. Once the thing shows blue, he said, I'm just praying, let this thing just show blue. Let it just show blue. Along, I will close it. And the moment the market enter blue, boom, like this, $1, $2. Look at somebody that has held $20 loss, $50 loss for 1 or 2 days. A 1 minute profit, he closes it. And after he closes it, the market will now continue going. He will say, it's as if somebody is watching me. Somebody is watching me in this market. Why is it that it was when I took the something, that is when the market started moving? Nobody is watching you. You will understand it better. Now, let's talk about the 7 essential money skills. If you don't understand these 7 essential money skills, you can't be successful as a trader. Now, the first one is, for money, you must value it. Many of us don't value money. Especially when, as a trader, when you put the money in your trading account, it becomes as if it's a toy in your hand. It becomes like a toy. $100. If I'm going to give you if I give you 100,000 naira now, in naira, those of you in Nigeria, if I give you 100,000 naira, man, are you going to throw away that money? No. 100,000 naira, that is much. But the moment you convert that 100,000 naira to dollars and it is on your MT4, it becomes like a digital thing. You just do 1, 2, 1, 2. I just lost $2. I just lost $3. I just lost $5. You don't value it. What you don't value, you can't control. What you don't value is when you put value on something, you begin to say, how do I place control on this thing? When you don't control it, anything that you don't control, you cannot manage. It will just go out of your hand. So one of the first key things, you as a trader, as you think of getting funds to begin to trade, you begin to think, one of the first things you have to think of is, how do I place control over my money? Now, once you can control it, it's money that you control, that you can save. Because you have control over it, you can say, I'm investing here. When I make money, I have the discipline. If I make 10% here, I have the discipline to save it. I'm going to save this money because you have the control over it. Now, once you can save money, the next step is the money that, I always say something, that money that you did not save cannot save you. Money that you did not save cannot save you. And how will you save it if you have not controlled it? How will you control it if you don't value it? So when you save it, you gather it to some extent. You gather a big chunk of it, then you can put it into investment. Many of us, the first thing you want to go into, you want to go straight from raising money. You want to go into investment that you don't know about. Part of control is you having knowledge. Part of saving is you having knowledge. Now, when you save money enough, you can now put it into an investment vehicle. When you put it into an investment vehicle, it now begins to work for you. Ladies and gentlemen, you are not making money yet until your money is making money for you. You are not making money yet until your money is making money for you. I suggest you go read this book, The Richest Man in Babylon. The Richest Man in Babylon. Now, many of us, when you make some money, somebody gave you $20,000. The next thing, you want to buy a car, you want to buy this. You say, if I get this kind of money, I will first of all settle my life first. I will first of all get a new clothes. I first of all get a new house. I first of all get a new. That is why you are not. That fellow cannot be rich. So once you get the money, the first thing you want to do, invest it. Once you invest it, the return on the investment, that is when you say you are making money. You now make the children of your investment to work for you. The money that you put into an investment, the return on investment, you make 20%, 30%. That is not for you to go and be, marrying the second wife, living a flamboyant life. That part of the money is what you make. You now use that aspect to be working in another area. That is when you talk about diversification of investment, diversification of portfolio. And that's when we say you are shielding your money. You are shielding your money. Many of us shield our money too early. You shield your money too early. No, this money, I cannot afford to lose it. I'm going to put it inside my bank. I'm going to put it somewhere. You shield your money too early. But it's money. That's when. And how do you shield? As far as a businessman is concerned, you diversify into different portfolio. Now, when the money that you've shielded, when they start making returns for you, this is when you begin to think of sharing it. It's the money that you have shielded. you valued it, you controlled it, you saved it, you invest, you make more money, you shielded your money. Now you have money that you can share. I remember growing up, my mom then had a business. Every time, oh, we complain, the money for the business is not much, it's not this, is this. But you know what? We share money too early. You just made a few money. Haven't you had sometimes when people talk about a rich man or rich person in their family, they say the guy is tight-fisted, he's too greedy, he doesn't give anybody money. No, what is he doing? He's shielding it. When it is multiplied, he will now have much to share. One of my mentors told me, he said, one of the things you should do for the poor is not to be poor yourself. Did you get that? As you begin your journey in the Forex industry, in the money market industry, I have no doubt that you'll become very rich. But one thing you must remember is this: the thing that you can do for the poor is not to be poor yourself. And for you not to be poor, you must learn to value money. You must learn to control it. You must learn to invest it. You must learn to make it work for you. You must learn to shield it before you think of sharing it. Those are the 7 essential money things. Now, when you have this, you now start thinking, okay, as relating to trading, how does this apply? If you don't understand investing, you will be less effective entrepreneur. A lot of entrepreneurs don't have investment. That's why we tell you, as you are in the academy, put in some money in the investment platform so that money is working for you. So at the end, you will have money to shield. And if you can shield it, you have money to share. You can control your trading funds. Now, let's quickly look at what are the essential money management practices that we have that you as a trader must imbibe. The first is what we call the risk-reward ratio. The risk-reward ratio. Guys, I want you to pay attention. You see, when you talk about trading, every trade carries a risk, potential risk, and potential reward. Potential risk, potential reward. So you will hear professionals talking about when they go into a trade, they will say, what is the RR? What is the risk reward? What is the RR ratio? The RRR, the risk reward ratio. Now, oftentimes you are always advised, make sure your risk reward is 1:2, minimum of 1:2 or 1:3, not 1:1, not 1:1. Now, let me explain this to you. You see, when you enter into a trade, and you have the habit of using 1:1 risk reward ratio, okay, I want to make $50 in this market and I'm going to risk $50. Do you get? Let me use in percentage now. I have 100%. I'm going to risk 5%. I'm hoping to gain 5%. So if I gain 5%, my money becomes 105. 105, is that not? But if I lose, that means my money will become 95%. Now, if I pick up another trade again and I calculate risk reward ratio again, and I said 1:1. Now, what is 1% of 95? 1% of 95, maybe it's another, maybe let's use 10% of 95. 10% of 95 is 9.5. 9.5. So if you gain that 9.5, so your money is going to be 9.5 plus the 95. That gives you maybe 104. Guys, I think I understand there are some of us that when we call the figures like this, you will rather want it to see it virtually. All right? Okay. All right. Let's look at something like this, guys. Now, if you have $100, this is $100, right? And you are playing with 1% RR. Are you getting? Or let's call it 10% so that's for ease of competition. All right, 10%. Now, if you gain, this is loss. This is loss. All right, please pay attention. So that when you begin to calculate how you want to make your risk reward to be, you have very clear understanding of what we're talking about. So here, let me just make small profits. No, it is not the best way to trade. Let me show you this. Now, if you gain, let's put this thing here. Insert. Okay. Now, 10%. 10% of this is $10. It's 10. If you gain, it's going to be what? 100 plus 10. All right? So it becomes 110. But if you lose, it's going to be what? 100 minus 10. That becomes 90. All right? Okay. Let's say you take the boat step again. You enter into this market again. And this time, you made a loss here. It's easy to say when you are making gains, it's going. But this time, you made a loss. And this is the balance of the account. Your account is now $90, all right? If you lose another 10%, let's say you are just risking 10% of your account. You are risking just 10% of your account. Now, what is 10% of $90? What's 10%? That's about $9. Now, if you trade and you make 10% of $90, probably your money is going to be 99. Is that not? It's going to be 99. All right? It's going to be 99. That's 90 plus 9. But if you lose, what happens? If you make a loss, it becomes what? 81. Just follow this. Now, whenever you gain, let's say the next trade, you now make a profit. You see, your money is now 81, right? Your money is now 81. Your money is 81. Let's say the next trade, you now make a profit. What is 10% of 81? That's 8.1. So this time around, you made a profit. Boom. So your money becomes 89. Now, note something here, guys. I want you to note something. You will have to make, for you to get back to 100, for you to get back to 100, you have to make 2 times. You have to make 2 times the profit. You have to make about 20% of the, even when you make 20%, let's look at this 81 now. What's 20%? What's 20% of 81? What's 20% of 81? This, let's say 20%. 20% of 81, this 20 times, now 20 times this 16. Just imagine, you lost, look at this, 10, you lost 10%, another 10%, which got you to this. Now you make 20%. Even at 20% profit, if you add 20 to this 81, you are not yet back to your initial capital. You are not yet back to your initial capital. But where you use the risk reward ratio of 1:2, if I lose $50, I have if I risk $50, I am looking at making $100. If I risk $50, so if I trade the first one and I make a loss, by the time I trade the second one, if it goes in profit, I could easily get back to my initial profit, to my initial capital. But all this has to do with some levels of computation, which I'm still going to show you on the platform here. All right. So let's look at this. Let's look at where is it? Okay. All right. Let's look at this. Please, you might have to go over it again for you to get it in. All right. So here, so the risk reward, always target a risk reward ratio of 1:2 or 1:3. And one of the things that we tell people in this market is you must know what you are ready to risk at every time. And this will bring me to that point where how do you protect your money as far as this market is concerned. I'm going to do something for you, which I hope will help you in all your trading career. It's going to help you throughout your trading career. If I tell you that if you follow this, you will never, ever, ever, ever lose money in this market. Hear me loud and clear. If you follow this, don't say, does this man know what he's talking about? If you follow this instruction, you will never, ever, ever lose money in this market. Now, let me prove it to you so that you have a good understanding of what we're talking about. When you come into the market, every time, one of the things that we tell people to do is never risk more than 1% of your portfolio in any trade. Never risk more than 1% of your portfolio in any trade. Now, what I have seen traders do, in a single sitting, a trader is ready to risk a lot of things, risk a lot of money in a single trade. When we say don't risk more than 1%, if you are doing, it's easily achieved, especially when you are using manual trading. For me, when I trade manually, I control a lot of things on my trade. But when you tend to use EA and things, expert advisors and things, expert advisors can give you, can make more profit for you, because when you are not trading, the expert advisor is trading and it takes a decision and things. You need, except it has been well programmed for you to control the risk. At times it's difficult to ascertain. Take for instance, there are some expert advisors that we use that use one of the systems we call martingale, that it will be multiplying. You will get to understand all those things later. But as a trader, when you are picking your trade manually, you are learning to trade. You become a professional. Never risk more than 1% of your portfolio. Do you know that in the UK, and those of you in the UK, you will bear me witness that if you give a trader, fund manager, if the maximum that a fund manager is allowed to risk in your portfolio is 3%. 3%. That is, I'm saying, a professional fund manager managing your fund must not risk more than 3% of your portfolio in a single trade. If a fund manager risks up to 5% in a single trade and he makes profit, and you get to know that he risks 5%, you can sue. You can sue. Risking 5% of your money, you can sue. Do you understand? I'm talking of licensed fund managers. So, you know that you are not licensed. Should you risk more than 1% of your portfolio? Should you risk more than 1%? Now, let's go and look at someone who risks just 1% of his portfolio. Now, it's simple. Just take this illustration and let's go this way. A person started trading. Let's take that $100 fellow once again. Let's take that $100 fellow. You started your account with $100, and your total risk is 1%. 1%. You risk 1%. If this trade goes against you, what is 1% of $100? 1% of $100 is 1% of $100 is what? $1. Please pay attention. Pay attention. If 1% of $100, and that means if I risk 1% of my account, this trade goes against me, I'm going to lose $1. Well, out of $100, if I lose $1, the earth is not going to collapse. I can still go into trade the next day. Let's say for every time you enter is that 1%. Now, the next day you go into trade with your equity this time around is 99. You enter into the trade again. Boom. You made a loss again. Now, what is your equity again? what will your equity be this time around? Your equity, your remaining balance will be what? About $98. I think let me just wrap it up to some to this. Okay, let's wrap this up so that it's not looking too. All right, so let's go day 1, day 2. Let's just put this down like this. I want you to see something here. Let's go down like this. So this is we call this day 1. We have called this day 1 up to day 18. So ladies and gentlemen, just look at this. For every time you enter the market is a loss. Every time you enter the market is a loss. I want somebody to put that information for me. How many times will you have to lose for you to lose $100 completely? Can you put it in the chat box? You are risking 1% of $100 in your trade. Every time you enter the market, it hits a stop loss. Every time you enter the market, it hits a stop loss. How many times will you trade? How long will you stay in the market? How many times will you lose for you to lose all your money? Guys, put it in the chat box. How many times? Oh, Ibrahim said 100 times, 99 times, 100 times. Now, ladies and gentlemen, except the Air Force in your village are winning critically. Except the Air Force in your village, they are winning you critically. That is when you will enter first one, second one, third one, that you never win any trade at all. And the 100 trades you took, even because you didn't even attend this academy, you don't even understand trading. Every trade you took, at least by the time you have reached number 50 and the money is remaining 50, you will say, come, let me go and settle something in my village before I come back. You will have to lose 100 times, but come, let's ask ourselves, how many traders lose up to 100 times before they say they've lost their portfolio? Most traders are the first 2-3 trades. The first, somebody funds his account because he's risking 20% of his money. The first 20% he lost, boom. The next thing, because he wants to make money, you will hear somebody say, I want to double my portfolio. I want to flip my portfolio. You want to flip your portfolio? Is that so? Is that how it is done? If it is so, everybody flips their portfolio, then we will all be mega rich in this system. Are you there? So one of the things that you should do is you must restrict your trading. Maximum. You want to do it, you are getting to be a professional. Professionals now, they don't do more than 2% of their portfolio. You don't risk more than 2%. You want to risk 2%, or you want to do it to the extreme, then you go 3%. But for a beginner, start with 1%. With this, by the time you have made several losses, you will know that there's something wrong with my trading. Let me go and check something out. So with this, I can tell you it will be difficult for you to lose all your money in this market following this money management strategy. All right? Do we get it? Do you get it? If you get it, let me see you. Let me see you type yes. If you understand what I've just said now, type yes. For you to lose all your money, then you must be doing something else in the market. Now, the other thing, thank you very much. Now, the other thing that we're going to look at now, I'm going to show you how do I determine 2% of my account, what lot size and things. There's what we call leverage. We tell you one of the money management things that you must understand is you must learn to use what we call stop loss and do not over trade by over leveraging your account. I have had many trainers will tell you, if you have $300 in your account, just use 0.01. If you have $500 in your account, use 0.05. They just give you something arbitrarily. Ladies and gentlemen, as a professional trader, this is what you do to know the lot size to use in your trade. There's a calculator here. We call it, if you go to myforexbook.com, write it down. There are different calculators, but I like to use this very well. My FX, I think it's my FXbook.com. Guys, this is one tool that you must use as a trader. This should be always with you. Now, when you go to myfxbook.com, that is where you see the economic calendar, where you see the news for the day. How can you be a professional trader? You want to trade in a day, you don't know the news. What are the major news that are coming in a day? And you call yourself, you say you are a trader. You must be prepared for any news that is coming. Now, when you get to that place, wow, why is this thing taking time? Now, when you get on my Forex book, there's a place you will see that is called calculator. My calculator. Why is this taking time? Why is it taking time? I had it open. I just wanted to show you. I wanted you to see how I got there. And this internet, it's in my net now. All right. Let's see this. I tell you guys, once you get this tool and you make up your mind to run with these tools, you will be saved in this market. No, but how many businesses can you tell yourself, I don't want to lose more than 1%? Is it in farming that you say, I don't want to lose more than 1%? Or is it in selling clothes or something that you say, I don't want to lose? Somebody breaks into your shop, they pack everything, it's gone. You are bringing stuffs. Somebody is bringing gari from Bomosho to Lagos. The rain begins to falls on all the product. Boom, it's gone. Do you understand? But in Forex, I can decide I don't want to lose more than this. This is one of the safest business to do in the world, guys. But it takes you having the knowledge of money management. Okay, whilst this is going on, I'm going to show you something that will also help you. Let's come to this place. Now, you see, when we talk about stop loss as a tool for money management, most of the time, you will hear people will say something like, they will tell me something like, just put your stop loss at 20 pips. Put your stop loss at 30 pips. Put your stop loss at 50 pips. Why? How did you come about that? Take, for instance, somebody who enters this market and he places a sell. He places a sell and he says stop loss is 30 pips or something. Do you understand? And the market goes, look at from here, you enter the market from here. Let's say it makes a sell here. You'll probably make a sell here. Let's look at, there's a cross here that I'm going to touch here. A cross here. You can use it to do some measurement. I enter the market around this place. I get it. I enter here, and if you click on it and drag it up like this, you will see some information that is very, very vital for your trading. Now, I'm going to interpret this thing to you because it is very, very essential for money management. Now, let's look at it. I'm going to squeeze this chart. Look at this plus, this magnifying glasses. I'm going to squeeze the chart. I put it negative. Wow, why is it taking time? Okay. All right. Now, look at this. So this is too small. Let's expand it a bit. Now, one of the things that we tell people to do amidst every other things that you need to know is this. Whenever you take a buying position, let's say you take a buying position, the market, okay, of course, I think by now you can tell me straight away that this market is in a downward trend. We have lower highs, lower lows, lower highs. This high is lower than this high. This high is lower than this high. This high, this high is lower than this high, and so on like that. This low, the low here is lower than this low. This low here is lower than this low. That's how you know a downward moving market. Now, we tell you that once you want to take a trade, and this market by all indications shows that it is going down. Maybe it broke structure or something. You are going to learn more about that. So I want to take a trade here. Where should I put my stop loss? 30 pips? 20 pips? Now, your stop loss should be placed at the nearest high of that market. The nearest high of that market. Now, let's look at something here. I'm going to explain this. If I take a sell position here, I put this line here, for one reason or the other, I'm selling here. I'm selling on this line here. Where should my stop loss be? I want to place my stop loss. Look at the last high. I'm entering the market. You know, by the time you are entering, all these ones by this side, you are not seeing them. These, you are just seeing this 1, 2, 3 red candles. All these ones, you are not, these ones are after the showcase. These ones came after you enter the market. If we all know that it's going to go down surely, then we don't even need stop loss. So, but because we don't know, we will have to go to the last high of this market here. Look at it here. Where this price, the height it went to, the last high before it made this low. Because if it comes back to this high, there's a tendency that the market could be reversing. Do you understand? So in most cases, if the trend is truly a downward trend, in most cases, markets will really come up to this high. The only time it will come up to this high is where we have stop loss hunts, where we have what we call stop loss hunts. So in order that stop loss hunt will not catch us, we will want to move. We will not use this peak exactly. We want to go like 5 or 6 pips above this high. We want to go like 5 to 6 pips above this high. Now, let you say, but how am I seeing the pips here? Now, this is what you are going to do. I click on this. This is where I'm entering the market, right? Please pay attention, guys. Pay attention, guys. I want you to get this. I enter the market here. Look at this, where at this point, you see where this red candle closed. The red candle closed here. So let me click on this, and I'm going to click on it. I put I'm holding my cursor. All right, and I came to this high here. Look at, can you see a cross? Now I put this at the very top of the high, the top of that high. I hope somebody is getting this. You will see 3 figures there. There's 5/762/1.4806. Now that 5 represents that you have covered 5 candles. You have covered 5 candles. You go now. All right. Let me see to expand this. What is all this? Sorry for this. Okay. Now, please watch this. Watch this. I want to enter the market at this point. At this point. When this candle closed, that's when I decided to enter the market. As I enter this market, I want to know, okay, where is my stop loss? Where am I placing my stop loss? Of course, we will have done a lot of this analysis. You know where you can probably enter. So I took a cross here, this cross here, this sign beside this arrow at the top here. Then I brought it to that place, that point where I wanted to enter the market, which is this. I take it, I drag it. You know, either you click your mouse or something, you drag it to this top. This gives you, as it showed me, 5 candles or 5 candles, then 775, and then it's telling me the price. If you look at the price to the extreme, that's 1.480. All right. Now, this is the place. That means from the point I want to enter to the next high, it is. You see that middle one, the 763, that means 76 pips. Remember, I told you, ignore the last one, ignore the last digit. So 763 means 76 pips. So from the place I want to enter to the place that I want my stop loss to be is 76 pips. But now remember, I said that add additional 5 pips to the 76, so that in case there's what you call a spike and they want to do what they call stop loss hunt, it will not pick you at this very top. So what I want to do, I add 6 to this 70. Let's say this is 75. 75 plus 6, I bring it here. Boom, this gives me like 81. So I have 1.480.96. Okay, so I'm going to bring this line here, 1.480.16, something around there. Wow. I hope I'm not losing you. I hope I'm not losing you. I take that again. I want you to, I hope you can. Okay, let me see if there's something here that I need to see. I try to expand this. Watch this. I entered the market at this point, and let me call this my entry price. There's something here. Okay, let's call this entry. Entry price line. Entry price line, right? These are entry price line, all right? This place. We now, when we enter, I said you will trace the high, the last high. Don't just say 30 pips stop loss. What we want to determine here is our stop loss. We are selling the market, all right? But we want to determine our stop loss. Where will our stop loss be? So we took from our entry price, we look at the last high of this market, and we added 6 pips to it. But how do we know how many pips from here to here, from the entry to the high point? I took a crosshair and measured. I put it at the bottom here and brought it to the top of that high here. And I got 75 or 76. I told you 758 here is about 75 pips. So if I'm going to add 5 to it, that will give me like 80 pips. 80 pips. Now, 80 pips above this. 80 pips above this. 80 pips from my entry point. That is my stop loss. 80 pips. So, and we said, okay, that is at about this line. All right. Now, how does that relate to the money management we're talking about? What this one has done is this. I have taken my stop loss out of the way of danger. Now, your stop loss goes a long way in determining your lot size. Which lot size are you going to use? What lot size are you going to use? Now, this brings me to the calculator. Why that is going on? I put it. Let's look at it here. Let's look at this place here. Let's look at this again. All right. Let's look at this again. I want you to take let's look at something here. Please watch this. Watch this. Can you see the high? Let's say I took a sell here for whatsoever reason. I decide to sell. I see this candle coming down, and I said, "Let me sell." If I want to sell here now, if I sell at this particular point, okay, let me use this stop. If I decide to sell at this particular point, let's say I sold at the close of this candle, where will I put my stop loss? I probably want to put my stop loss at the last level of the high here. So my SL will be here. This area is my entry. This is my entry. I enter the market here. All right. I enter here and put my stop loss will be here. Now, the reason why I said I will not just put my stop loss at just the tente of this place, just at this edge, is because the market can come back here to this place to test this high again. It can come back to test this high in the form of stop loss hunt or market trying to restructure, create its structure. So instead of me putting my stop loss at the very edge of this place, I want to give it like a 5 pips gap. So I will come and put my stop loss at this line here. But all is based on calculation. Now, did markets do that? Look at the market came down here, came up here, Do you see that it came even up to the same level? So if my stop loss is exactly here, boom, what will have happened? It will take me out of my stop loss, and then the moment it takes me out of my stop loss, I see it going down. I say, oh, they just targeted my stop loss. They just went to pick me up at my stop loss, and then they started going down. Okay, it's better now. Okay, it's very clear. Okay, all right. So this is how you calculate, you put in your stop loss. You see, if we enter there and we maintain this, let me take this line. Let me take this line here and bring it down here. Boom. Can you see something? If I put my stop loss around here, what happened? The market came up again, picked it up, and the moment it picked it up, boom, tested it again and started going down. Don't worry, I'm still going to be talking, when we start talking about trading strategy, I'll be talking of supply zone and demand zones. Supply zones and demand zones. So this, it came back here, picked it, and then went. Then somebody will say, oh, they just targeted my stop loss. Nobody is targeting your stop loss. It's you that don't know where to place it. So what I want to do, instead of putting my stop loss at the high exactly, I want to give it like a 5 pips gap, a 5 to 10 pips gap, and I put it somewhere around here, so that even if the market, if it now comes here, and because if the market comes up here and pick it up, there is likely that there's going to be a change in structure of the market, and the market is actually ready to start going up. It may be, it's one of those things, but then it's better for me to stay in a safer place. So now, if I look at from this entry point to where my stop loss is a total of 73 pips or 72 pips. So what should my lot size, what lot size should I use? Now, let's look at this. This is a calculator. Don't ever, please, as a professional trader, I'm setting my, because I have $100 in the account, I will use 0.01. I have $30 in the account, I will 5. No, this is how you come. When you come, you see economic calendar. Can you see economic calendar? Can you see FX calculator? The FX calculator. You can click on this calculator. I don't want to risk clicking anything again because of the time. Now, it now depends on the pair that I am trading. If I'm trading Euro USD, the currency is in USD. What is my account size? My account is $500. Shola, how much are you ready to risk in this market? Okay, I can risk 2%. What is 2%? That's about $10. Is that not? $10. That's not too much. I can risk 2%. What is your stop loss? Remember, I told you your stop loss is critical to your computation of your lot sizing. So my stop loss, what is my stop loss? From what we saw on the other side, we calculated about 70, we say it's about 75 pips from the entry point. From the entry point to this area, we got it at 75 pips. And how did we do it? We put on this and we came to the point where we are entering. We dragged it to the top where we want, and we saw, okay, this is about 71 pips. All right. So I'm going to go back there and put 71 pips here. Then click on calculate. Once I click on calculate, the system is telling me that in this market, if you just want to risk 1%, 2% of your money, and you don't want to lose more than that, don't trade with more than 0.01 lot size. Don't trade with more than 0.01 lot size. If you trade with 0.02, 0.03, 0.04, you are over trading. You might make money actually, but if it goes on the other side, you will lose a lot of money. So here, I don't want to lose more than 10. It has told me what I'm ready to risk. This is what I want to risk. And it tells me use 0.01. But let's say in a situation, I have the same $500 and I'm able to enter what you call a sniper entry. I can make a sniper entry that, wow, I enter this market and I put in my stop loss. It's, I want to look for an example of such. Okay, maybe I enter the market at this point. I enter the market and I put my stop loss here, very, very close there. I make it very, very tight. Maybe because I've done some analysis and I'm sure of it and everything. So I have my stop loss instead of 71. Instead of 71, I still have the same capital, but this time around, my stop loss is about 30 pips. My stop loss is about 30 pips. Which lot size should I use? If I click on it, can you see the same amount of money, the same currency, the same amount I'm going to risk, but the lot size is what? 0.03. You know, somebody using 0.03 is going to make more money than somebody using 0.01. But remember, the person with 0.01 has his stop loss at 71. But you, with 0.03, your stop loss is at 30 pips. So if the market goes against you, it will easily knock you out faster than it will knock out the person that did about 71 pips. I want you to get that. That means you are risking more. So for you to risk more, please make sure you are risking based on professional information that you have. I have seen friends that use even 5 pips stop loss. They use 5 pips. When you use the ICT model and strategy, you can use as low as 5 pips stop loss. So if I put 5 pips stop loss here, can you imagine? And I put, it's telling me that, look at, it says I can use 0.2 lot size against 5 pips stop loss. If the market goes, 5 pips is very easy for the market to knock out. If the market hits me at 5 pips, I will lose $10. And the same thing, the man that used 0.03, if the market goes against the person 30 pips, he will lose $10 also. And the one that used 0.01 lot size, if the market goes against him 71 pips, he will still lose the same $10. But now let's just imagine, if I had used $0.2, if I use 0.2 lot size, and I didn't put this stop loss at 5 pips. I didn't put this stop loss at 5 pips. This is telling me that 5 pips is $10. And instead of 10, let's do something. Let me show you so that you will understand the power of this stuff. All right. This 5 pips is $10 at 0.02. Now, if I didn't put this stop loss and the market goes against me 70 pips, if you divide, how many 5 pips can we see in 70 pips? Oh, maybe you can see up to 1. Is that not 1, 2, 4, 14? Ladies and gentlemen, that means I will have lost $10 14 times. Of course, there's not for $10 times 14, 10 times 14, 10 times 14. That will be what? $140 if the market goes against me up to 70 pips. If the market goes against me up to 70 pips, while I use 0.02. But if I've used my stop loss, the thing gets me at 5 pips, boom, it will take me out. It will take me out, and that is all. I look for the next opportunity to enter the market again. So, a lot of time, a lot of persons will tell you, I don't like to use stop loss. If I use stop loss, the market will hit me. Let me give you a practical experience. When I started as a young trader, when I started trading, on a particular day, I was going to a particular state. I was going to Abeokuta to go and do training in my days with International Market Life. And as we were going, I was driving. There was one terrible hold-up at the Lagos-Ibadan Expressway. In those days, it used to be very terrible. Now, I took a trade. In that traffic, I took a trade. And the trade was, before I got to Abeokuta, I'd already done, the trade had given me about $500. You know, when you made $500 inside traffic, you are so happy and proud of yourself. So when I was training people there, I said, can you see? I was inside the hold up. I made $500 and things like this. After the whole seminar, I finished. Then I was training them on, there's one strategy that I was training there. So I was this what's this? The shark, I've forgotten. The name just skipped me. So after that trading, I now saw there was one trade opportunity, and I was about driving out of Abeokuta, coming back to Lagos, and I just saw that trade opportunity. A guy called my attention that this thing has done, that this thing looks like a good opportunity, and I just said, okay, if I made $500 coming to Abeokuta, it would not be a bad idea to make $500 going back to Lagos. I took the trade. I set my stop loss. I set my stop loss at about $100, that if it hits me at $100, there's no problem. At least it's just $100 from the $500 that I made. And if it goes into profit, that's $1,000 that day. Along the line, as I was driving, there are places that I couldn't get network. When I checked, I saw the trade going. When I now got network, I checked my phone. I saw the trade going against me. And as at that point, I said, if this thing hits me here and then begins to go down, this one will be painful. What I now did is, I said, let me remove the stop loss. So that it will just go and then come down. Ladies and gentlemen, I never knew I opened expressway for the blowing of that account. And the markets began to go. It passed. By the time I got to Lagos, that 500 that I made, it has taken it first. It was in drawdown. I was just, if it's that one, it will have been good. It went further, 1,000, 1,005. For about 2 weeks, the market was going up. To cut it now, it now became a problem for me. How can I cut this trade? And I know, it will come down. It will come down. This market did not come down. Ladies and gentlemen, before I said Jack Robinson, I got to the house when I couldn't eat for, your mind. This was supposed to be children's school fees that I said, let me just quickly turn over before I pay the school fees. And this thing is happening. How am I going to do? I was so downcasted. Ladies and gentlemen, in the long run, I lost that portfolio just because I took away a stop loss. Never play with your stop loss. It's better you lose that money. I tell you, even at professional level, even now, till now, as a professional trader, I still do that. Sometimes I will see the thing is getting to hit my stop loss. I will do some other analysis. I say, no. It's not supposed to be. Let me remove the stop loss. And you see the market. It's happened to me even recently. Do you understand? So, but the discipline for you to stick to your stop loss. You said you can risk $5. Why are you removing the stop loss? Leave it. Let it hit you, and you look for another opportunity to enter the market again. This is how you become a professional trader. So, guys, this is one key aspect that you understand in your trading career. All right. So let's quickly look at. I've talked about the stop loss, and I've talked about the over trading. Avoid over trading. And how do you avoid over trading? By using the right lot size, in your trade. Now, you see, when you don't use stop loss, I illustrate this thing like a man. Look at this man, this young man. This lion is on chains there. This man is carrying with his big belly. He's using chicken to do kodai for the lion. Okay, you see, as long as this chain, you know that no matter how this lion gets angry, it cannot go beyond this chain. So, guys, if this man decides to stay here, they say this is the boundary. If the man stays here, can the lion do anything to him? The lion cannot do anything, because this is the region, the stop loss region. Now, let's look at something here. Let's say somebody, as this man is standing here, right? Somebody now said, Mr. Ben, take this bundle, and he throws a bundle of $100. That is about $10,000. And the $10,000 dropped around here. We are not talking of 10,000 naira, 10,000 US dollars. A bundle drops here. But this time around, this lion is sitting by the tree and relaxing. Now, this is where the the line of safety is. This he has been here doing it using 0.01 trading, but now he wants to make the big money. He wants to make the big money. What does he do? When he saw this person threw the money and the money fell to this place, wow, the lion will see the money, the man will see the money. He said, the lion will say, oh my God. Two people will go into prayer immediately. Two people will, two creatures will start to pray. The man will begin to pray, God, let this lion sleep off so that I can jump in and take this money and jump out. Lord, please allow this lion to sleep. And the lion on his own will stay in his corner and be saying, God, please don't interfere in this matter. You just leave me and this man alone. God, please don't interfere in this matter. This man is praying God. Now, it is possible that the lion will doze off and the man will jump here, boom, pick this money and jump out again. Oh, I made $10,000. I made $10,000. Such is the many people you see. They say, oh, I made so. Can they repeat it? Can you repeat it? Now, what of if, while the man was jumping, as he was jumping in to catch the money, the lion was also jumping because God answered his prayer and God did not interfere in the matter? What will happen? The case will be like this fellow. You become a Samson. All your accounts will turn to red because you will have to struggle and fight with the market. You will be losing blood, you'll be seeing red in your account, and until, well, if you are lucky, you kill the lion, you come out with bruises. But if not, the lion takes you away. Guys, bottom line, don't trade without stop loss. Don't trade without stop loss. So that's why we tell you in the investment platform, make sure you set your stop loss at 50 whilst we still use our own stop loss. So ladies and gentlemen, that is it on the money management. Quickly, let's talk on the psychology of trading. Being a good trader involves, and then let me be sure, did you get something? Did you get something in the money management aspect? Put a 222 in the chat box quickly. Let me be sure you got something in that area, some key thing that you got in that area of money management. All right, let me see. Put a 22. Okay, thank you. Okay, awesome. This is good. I can see great traders. We're going to be great traders here, guys, in this academy. Now, let's quickly look at the psychology. What's the psychology of a trader? Let me tell you this, guys. They said trading is more than just technical analysis, fundamental analysis. One of the most crucial things that you must have as a trader is an healthy mental outlook. Calmness of mind is one of the beautiful jewels of wisdom. Calmness. Guys, please, never you say you have a quarrel with your husband or with your wife and you now say, let me just leave me, let me go and trade. No, sir. Oh, somebody upsets you, you now go and sit down to trade. No, sir. Oh, you've lost some money, you now say, I want to revenge in the market. No, sir. Calmness of mind is one of the beautiful jewels of wisdom. No matter how skilled you are, if you are not calm when you get to your trading desk, you can lose your money. So what do you need to do? Now, the key areas that you need to understand as far as trading is concerned is you must have emotional detachment from your money. Emotional detachment. See, when you are trading the demo account, you can afford to leave your money and then you say it's going up. It will come down. I know it will come down. I know. That's how yesterday it went up, and then it came down. See, when it is your real money, guys, people always ask me, they say, Shola, what is the difference between life money and demo account? I say there's nothing different in them. Life money and demo, they are the same thing. They say, no. In the demo, they will make you to make money. In the life, they will not be watching you. Nobody is watching you anywhere. The only difference between them is your emotion. $100 is your money. That $10,000 in demo is not your money. So when the inside the $10,000 you are trading, you even use one standard lot size, you are trading, the thing is going against you, $100, $200, it's just going up, it will come down. That's like yesterday, it went up, it came down. Oh boy, when it is your $100, your real money that is there, when it's going 100 to $10, your body will start. You say, hey, this thing. Should I? So somebody called me and said, Mr. Shola, the thing is, I'm seeing red. I'm saying, should I cut it? Should I cut it? Did you cut it when you were doing demo? If you did not cut it when you are doing demo, why do you want to cut it now? Leave it. Maybe it went up and it came down. It will come down. If you didn't use your stop loss. But if you have used your stop loss, you don't have anything to fear. Well, if it hits you at the stop loss, well and good. So your psychology is very, very, very important. There's no difference between your demo and your life other than your emotion. Be emotionally detached to your trade. When you are emotionally attached to your trade, I tell you, you will take wrong decision. You might have jumped out of the moment you jump out. That is when you now see the market going in your direction. So have emotional detachment from your trade. Know when to take a break. It's not you'll be making loss. If you made a loss today, loss tomorrow, take a break out of this market. What are the 10 major mistakes that people make in this market? Failure to have a trading plan in place before they start to take trade. Before you have a trading plan, plan your trade and trade your plan. Inadequate trading assets or improper money management. You have 100. Somebody said, "Can I start trading with $100?" I tell you, if you started with $100 as an amateur, you are about giving your money as gift to the market. I tell you, 100%, 95% of the time, 95% of traders that start with $100, $200, they end up losing the money. Guys, I am telling you, 95. What's 95? 99% of new traders that fund their accounts with $100, $200, they end up losing their money. So when we started and we say, okay, you can deposit $200, you can use it's more difficult for us to trade the $200, the $300. There are accounts of $50,000 that you don't even bother about. If it goes on drawdown, you know it's going to balance up and everything. Do you understand? So, but that's why we say, okay, put it in an investment while you learn the skill of trading. Expectations that are too high too soon. I'm going to flip my account. I want to make 20%. I want to use the money to buy car. I want to spend the money in Christmas. Expectation too high too soon. Failure to use protective stop. Lack of patience and discipline. Trading against the trend or trying to pick tops. I'm going to talk of that. I'm going to talk on that when we talk about when we are using the indicator stochastic and RSI. They say the market has reached the top. It must come down. It has reached the top. It must come down. It must come down. Now you carry and go up. Now you put on there. You say it must come down. Come down to where? If it can stay there, I will explain it when we get to that particular indicator. So don't trade. Look at structures before. Allow losing position to ride on for too long. Over trading is another one. Failure to accept full, complete responsibility for your action. It is you that told me to buy. Yeah, I didn't want to buy. The market, in fact, is a broker that you take responsibility, not getting the bigger picture perspective of the market. That's you don't look at the economic news and everything like that. These are the things that affects you in the market. So survival factor, money management. The next one is discipline with stops. When to trade, when to call it a day. Then you must have confidence. Have confidence. If you have done your analysis properly, pull the trigger. A lot of people have done a lot of analysis. When it gets to the time to pull the trigger, they become afraid. Then you now see the market going in the same direction as you have analyzed. But you say, oh, why didn't I enter this market? Then, it becomes something else. So this you achieve by how do you imbibe money management, discipline, and confidence? You do it by protection of your trading funds. Remember, I told you, value it, control it, keep it. You learn your setups. Which setups must I see before I enter the trade? Then learning your weakness and your strength, dealing with greed, fear, and emotion. You see, these three agents, they have come to the market to kill to steal, to kill, and to destroy. Your greed, your fear, and your emotion, they are in the market to kill and to destroy you. So if you are able to master your greed, and you know what, you say when people say, I've learned how to master my greed, I say you've not started trading. When you start seeing dollar, you see, if you enter now, the thing enters $10, $20, you think it's easy. When you are alone with your phone, you think it's easy to master greed. Oh my God, come and trade Forex and you make money. Then when you conquer that area, you tell me you've conquered greed. Remember, you cannot make it to this stage without prior step. If you did not survive, nor develop a trading system, nor have goals, you may recognize setups, but you will not have confidence or cash, etc., to take advantage of the setup. I sometimes compare it to being the pro, like the lion that is waiting patiently for his prey and then attack when it is the right time. So, ladies and gentlemen, finally, I'm going to tell you what you should take up in the psychology of trading. You must be a patient person. You must have confidence and not overconfidence. You must know what your risk capital is, and some days you must know when to trade and when not to trade. Highly recommended translating your trading decision into actions and reactions. Trading is not a black box. It will help you if you can eliminate that enemy, fear and greed. Ladies and gentlemen, at this point, I've told you, take away emotional detachment. You must have that. Know when to take a break. Know your setups. Make trading mechanical. Excellent risk reward. Avoid over trading and discipline yourself. At this junction, I want to tell you, if you follow these words, happy are you if you do them. If you follow this simple principle, I tell you, you will never, ever, ever blow an account again in your life. Once again, it's your friend and partner, Olushola Popola. See you at the very top of your trading career. Bye-bye.
Waking up at dawnlight, breaking through, chasing dreams, no time to lose. In this race we strive and grind, motivation fuels the mind. Gonna rise up, we won't fall, breaking barriers through it all. Step by step our journey's clear, success is closer, don't you fear. Challenges we face headstrong, in this rhythm